Hey everyone, welcome back to Corporate Decoder, the place where we turn confusing corporate reports into something you can actually understand. Today we are diving into the world of government bonds. Does that sound a snooze fest? Well, it is until you realize it's your money. So stick around because we are going to take a look at where that money is, how it did, and what the chances are of it doing better. Before we get started, if you aren't getting value from these simplified corporate insights, remember to like and subscribe. There is also a Discord community that you can join, linked in the description below. So we are looking at the annual shareholder report for the Columbia U.S. Treasury Index Fund. This fund is all about investing in U.S. Treasury bonds, so it's considered a pretty safe investment. We'll break down how the fund performed the past year and see if it's really as steady as everyone says at. Let's kick things off with how much it costs to keep your money in this fund. Here we see a hypothetical look. Imagine you put $10,000 into Class A shares of this fund. Over the last annual year, the expense would be about $33 or 0.32% of your investment. Institutional classes are less, so you might keep that in mind when choosing a vendor for retirement. What did you get for your expenditure? Let's scroll to the fund's performance and what the report writers had to say about that. Alright, time to check the numbers. For Class A shares, we're looking at a 7.26% return for the past year. Not bad, you might say, but let's put that in perspective. The fund compares its performance to two benchmarks. The first, the U.S. Treasury Index, had a return of 7. The fund compares its performance to two benchmarks. The first, the U.S. Treasury Index, had a return of 24. Over the longer term, a run year into it includes the impact of the end of tours you might not have. So it's always nice to have a vendor do it for you. However, with this in mind, let us see the investment over several years. Over 5 years, all of them are negative, about 2% for several years, and less than on your own in any of these indexes. You would have done slightly better. But of course you might not have, so it's always nice to have a vendor do it for you. However, with this in mind, let us see on less than 1% for Bloomberg. These are the consequences of previous interest rate hikes and are probably temporary. Note that this filing is dated April 30, 2025, which means that it includes the impact of the end of 2024, over the longer term 1% a year, on top of inflation. It's important to remember that past performance is not a guarantee of future success. Anything can happen, so keep an eye on the market. Next, let us see some analysis about why the fund did as it did. What made the fund tick and perform as it did? A couple of things stood out. Intermediate maturity US Treasuries, that is bonds that come due in a few years, really helped drive performance, as did something called the yield curve. The yield curve steepened, which is a fancy way of saying that the difference between short-term and long-term bond yields got bigger. This generally happens when investors expect economic growth to pick up, and what not contributed to the fund. The text indicates that shorter-term treasuries, that's bonds maturing in 1 to 3 years, didn't contribute as much to the overall gains. This is because while they had positive returns, they weren't as high as their longer-term counterparts. Also, US Treasuries that were longer than 10 years also returned less for the same period. The fund also provides key statistics, so let's go there. The fund had about at $117.6 million in net assets. It held 275 different securities or bonds. The management service fees ate up around $4 million, which represents 0.40 the first mile. Let's scroll to arguably the most important part. These are the bonds that make up the biggest chunk of the fund's investments. You'll see a bunch of US Treasury bonds with different maturity dates and interest rates or coupon rates. Notice how each makes up around 0.9% of the fund's holdings. And so they are fairly evenly distributed, which is to expect from an index fund. The bond are listed by dates and interest rates, which can tell a lot about the economic situation and risk that they cover to them. But let's not dive too deep. The report also contains the asset categories. In a nutshell, almost all 98.9% of the fund is in US Treasury obligations. The rest, 0.3%, is in money market funds. So it is a very focused fund, which matches its name. Another way the report looks at the fund is by credit quality. The scale goes from AAA, best, to not rated. The quality of almost all holdings is AAA or equivalent. Again, this fund is about holding the safest assets around, backed by the US government. Done now, let's shift our focus to something really important: expenses and fees waived. The investment manager, Columbian Management Investment Advisors, pitches in to keep the fund's expenses down. they are contractually committed through August 31, 2025 to make sure that net expenses don't go above a certain percentage of the fund's assets. This essentially ensures they give a refund check, so to speak, to the fund and reduces the cost for the shareholders. If the investment manager had not done that, waiving that money, the fees would have been notably higher. With that said, how do you know that they did not hold back on the investment return? Well, they did not beat averages in several metrics, so you may need to consider that. See all returns above that, talk about indexes as benchmarks. We are now looking at the actual performance and money going in or out of the fund. This brings us to everyone's favorite, more tables. Let's break down the changes in net assets, which is like the fund's bank account statement. The fund tells us that the net assets went down about $291. That might sound scary, but keep in mind, net assets can decrease for three reasons. Operations, which reflects investment performance. Distributions, 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 which reflects investment performance. 1. Looking at this capital stock activity, we can see that more money went out than came in. How do we know? Because it is a negative $3113 million. This is the NHM thing that explains the fall of total net assets. This is more than the negative returns attributed to normal market fluctuations around 30MC operations and is a serious loss of investor confidence or large client leaving. Let's take a high-level view of the report that we quickly went through. It had an average performance, it is a very safe fund, it has declining assets under management, and it has average yields as far as total return is concerned. But does this really indicate a crisis or something to run away from? Let's quickly recap and give an overall impression. The fund follows the market, and the market did about average over the last year. The 1-year return of 7.26% is positive, which is good. Over 5 and 10 years, the returns are not impressive, around 1% above inflation at best. A far cry from the usual index fund. The key takeaway is not results for 2024, which are good due to end-of-year market trends, but the loss of investor confidence shown by the capital flight, so to speak. However, you have to see things through. With increased interest rates, people might be less likely to buy government bonds at the current price and might seek other opportunities. With that said, I would keep an eye on this fund for 2025 end report. Things can turn around very quickly. Alright, that's our breakdown of Columbia US Treasury Index Fund latest report. What do you think of these numbers and the market conditions they reflect? Drop your thoughts about the investment into the comment section. If this analysis was valuable to you, hitting that like button really helps, and subscribe for more deep dives into corporate activities. Don't forget to check out the Discord link in the description where we discuss this further. Thanks for watching and see you next time.